Hi, and I want to welcome everybody to this video. I've got Alan Hibbard with me once again. Alan, how are you doing?
I'm great, Mike. Thanks. How are you?
Great. And so I've got a presentation on the stock market and precious metals, and it's sort of where we're at right now. We're at the beginning of a new year, and I think that this year is going to be a very, very exciting and, for some people, scary year. Do you have any feelings on that?
I agree with everything you just said.
Excellent. So I'm going to present something now. So this is the S&P 500 going back to 1925. The S&P 500 actually started in 1950, but Dr. Robert Shiller compiled the information required on the 500 largest companies in the United States to take this all the way back to 1925. Actually takes it back to, I believe, 1890. But stock charts is using the S&P going back to 1925 here. So I've generated this logarithmic chart. And for a reminder for everybody, each inch or each repeat of the same distance on this chart vertically is a fixed percentage change. So it'll be the same change in percentage gains or losses. And what I wanted to talk about first, I'm going to cover a little bit of where we are today and then revisit the first part of this century and then take a look into the 70s. When the gold bull market started, what was the stock market doing? And then I also want to just touch on the 1929 Great Depression and all of that. So here is today. This is, and what you see here is something that should give stock investors some real trepidation. This is a classic double top. And I don't see any bullish pattern in the middle, like a well-defined there. You could make a case for an inverse head and shoulders here. But, with gold, there's a whole bunch of bullish fundamentals. And then we had a whole bunch of bullish technical indicators on top of that. And then, and so we broke through something on gold called a triple top, which is an extreme resistance. And that confirms all of the other bullish signals. I've been looking for something like that in the stock market, and I just don't see it. Got any comments on a double top and what it means?
Yeah, I'm also looking for bullish signals, and I don't see any. None here. But if we think about how the Federal Reserve has as a stated objective of quantitative easing, the intentional goal of inflating the stock market to create a wealth effect, which somehow causes people to spend money and stimulates the economy. That's the bullish thing that I see in stocks, which isn't even in the chart. It's just kind of knowing how the central bank works.
Right, but it has also created the bubble, which is a negative fundamental for a continued bull market. They were already so stretched above anything that resembles reality. The stock market has gone crazy, and this century it's gone crazy, but especially since 2008, it's just totally insane. And it's all because of the Federal Reserve manipulation. And we know that, the more you twist and manipulate something out of shape, the more vicious the snapback is when it reverts to mean that the free market will always it will overwhelm the manipulation, even by an authority like the Federal Reserve or some other central bank. So I just wanted to point out this double top, and then, to say that, well, the Dow Jones, if we look at that, we've already exceeded the previous high. So the party is on. We should, everybody should rush back into the stock market now, because the Dow Jones Industrial Average, back in when I first started noticing the world of finance, and I wasn't in it then, but when I started noticing it back in the 70s and 80s, nobody knew what the S&P was. You didn't hear the S&P 500 mentioned on the news. It was the Dow Jones. This is what everybody talked about when they were talking about the world of finance. They said the Dow Jones Industrials did this today. And so this is the 30 largest industrial companies in the United States, but it has hit record highs. And so when you're in record highs, the trend is your friend. You want to rush back into the stock market, but wait a minute, the NASDAQ is not at record highs. It hasn't even put in a double top yet. So so we have these non-confirmations. The Dow Jones suggesting that the S&P 500 should start putting in record highs and exceed its double top, which if those did, should drag the NASDAQ up with it. But then I want to step back a little, take a look at a longer time frame. So you've got the double top here. Now, this was made January 5th, so it's fairly recent, but we've got the double top. But what I want to look at here is the last time that the S&P put in a double top, and this was a big double top. This is 7 years that this double top took to form. So if you were an investor that invested in the year 2000, right when the NASDAQ was peaking and the S&P was peaking, it crashed, and it took you 13 years to get back to break even, not inflation adjusted, not in real dollars, but in nominal terms. It took you 13 years. And as you know, because you were the one that did all the charts on this in the book, we inflation adjusted it using the CPY, which gives us the lowest inflation figures possible. And we came out with 17 years that an investor was underwater waiting to get back up to break even if he had started investing. I don't know why people keep on rushing back to the stock market when it keeps on punishing you. You go back to Wall Street, they say, come in and let us manage your money. And then they whack you over the head with a stick and you just keep on coming back for more. Got any comments on that?
Yeah, I think I know why people keep rushing back to the stock market. And it's a combination of that's what their financial advisors tell them to do, because that's what they're told is the right thing to do, right? It's that 70-30 mix of stocks and bonds, or 60-40, depending on your age and your risk tolerance. But like, financial advisors don't recommend gold. They don't recommend alternative assets like fine art or a whole other host of things, because it's harder to make for them to make commissions on those things. So everyone goes into the stock market because they're told to, and they think they're doing the right thing. And it's only a matter of time before that gigantic rug pull, and the central banks stop the flow of currency and withdraw the easy credit, and everything crashes.
So what was happening with this last double top? Well, turns out the Dow was breaking into brand new highs in 2007. When everything crashed, this was saying it's time to party again. It's time to rush back into the stock market. But just like today, the NASDAQ wasn't confirming. This is a repeat. Today is a repeat. You can see the double top today also. And it isn't a double top on the NASDAQ. On the Dow, hi, I just wanted to take a moment and thank you for subscribing, and mention that if you'd like to help our channel, please consider my company, GoldSilver.com, the next time you buy precious metals. We're one of the most trusted names in the industry. Our prices are sharp, delivery is fast, and we have an insiders program where you find out exactly what I'm doing with my own investments. Thanks for making GoldSilver.com your dealer. And now back to the video. Dow, today in 2024, we have pushed up into brand new highs, just like we did in 2007 on the Dow. And you go back to the S&P, and you've got two double tops. And it turned out that the S&P was the right one to watch here. The S&P controlled the others. The 500 largest companies in America is giving you a picture of what the economy is. The NASDAQ is giving you a picture of what tech is doing. And the Dow Jones Industrial is the largest industrial companies, but being only 30, it doesn't give you a large enough sample. And so the thing to watch here is the S&P. And if we're putting in a double top, just like we did back in 2007, investors lost a lot on that double top. How much did they lose? Well, I want to go back even further. So this is stepping back so we're getting a picture all the way to the end of the 1974 bear market. This was a huge plunge in the stock market, the 1974 bear market. And when it bounced toward the latter half of 74, that's when this giant secular bull market in stocks from 74 to 2000 started. Some people like to measure from late 82 here. But actually, I mean, you look at this trend, it's 74 is the bottom. So using Fibonacci retracements, and you can explain to the audience what Fibonacci retracements are, what Fibonacci numbers are. But using that on stock charts, it shows that you had almost from the entire bull market starting in 74. If you just rode this thing, it was great until it was time to get out in 2000, but most people didn't. It is so hard to time these things, but it isn't as hard to measure them. And you lost 50% of all of your gains that you made in 74 to 2000 is 26 years. And then in the next 29 years later, you had lost 29 years total. 3 years later, you had lost half of everything that you made in all of that time. And then you waited that till 2007, another 7 years from the previous peak to get back to break even. And you said, wow, here I am. I'm finally making gains again. And then what happens is you lose 60% roughly of what you made in 39 years. Why does the average investor keep on going back to Wall Street for more after this kind of punishment? But they do. So here is the taking a look at this in the really long term. And remember the percentage. So the crash the pullback that we went to from the end of 2022, I think this was, or 2021, when the stock market peaked and now we're making a double top, that is small in comparison to the crash of the NASDAQ. This is the S&P, but this coincides with the dates. The NASDAQ is sort of what pulled everything down because it was everybody's darling back in the year 2000. And you'll notice that the size of this 50% retracement, it's about the same size, and people lost about 50% in their, it's 50% from the last run-up, basically, is, so the last major where the bull market started. And then back here, you can see that those are nothing. These crashes here and here are nothing compared to 1929. This was the Dow Jones was just a breath away from 400 points. It was like 396, I believe. And I know that this bottom in 1932 was 40.22 points. So it was around an 89% crash, close to 90%. Any comments on history? Mark Twain is said to have said that history doesn't repeat, but it rhymes really well. And I say that history always repeats, but with little twists. And we see history repeating in here. Have we learned our lessons from the past?
Yeah, I don't know. But to answer your question of why do people keep doing this, I was sort of just reflecting upon that quote that it's better for reputation to fail conventionally than to succeed unconventionally. So in other words, if you want to still get along with people well, it's better to fail actually the same way that other people fail. All fail together, and then at least you can all get along. And that's what happens in the stock market. I mean, that's what happened in the Great Depression. Like everyone was in the same boat. They all failed the same way. But if you somehow succeeded in that period by doing something contrarian or out of the norm, you sort of like ostracize yourself from others. So I think people are kind of afraid of that.
Yes, I suppose that is part of the psychology. Now I want to turn our attention toward gold. And as you know, we have set last year, the end of last year, a bunch of record highs were set. The last day of trading wasn't the highest on the daily, but in that week was a record high for the daily. But professional traders and good long-term investors will look more at just the daily data. This is the weekly data where the breakout of all-time highs in that final week becomes even more obvious. And then we have the monthly data, the gold setting all-time brand new record highs on the last month of 2023, and then the quarterly and the annual. There is nothing more bullish than all of these charts lining up at record highs. Any comments on that?
Yeah, exactly. You know, when we look at the gold charts for bullish indicators, they're pretty clear. And then when we look at the stock charts for bullish indicators, they're like really hard to find. They're like just simply not there. So
right.
Yeah, I think that really tells a story.
On that same note, looking for bullish indicators, I started presenting this. This is probably from 2 months ago or so, maybe 3. I presented at a conference in Nassau, and so I used this chart to point out a few of the bullish signs. There's this big pan and handle that had formed, or cup and handle. You may have heard it referred to as, when it gets long and stretched, it's more of a pan and handle. When it happens in a shorter time frame and it's got more vertical height, they call it a cup and handle. But being that this has developed from 2011 to today, this is extremely bullish over the long term for gold, that pan and handle, and you can see it there, and there it is again. And then when gold peaked right here and started a retreat, I did an insiders video and told all of my insiders, I believe this is forming a head and shoulders pattern. So what you want to look for is when as it's pulling back, these are probably times that are going to end up being a good buy-in point, and one of the last chances to do that before we break into new highs, if it is a head and shoulders. But I also, an inverse head and shoulders forming. But I also pointed out that there was this triple top. And now that is normally a very bearish signal. You get up to a resistance area, you get up to it again, you get up to it again. Now, most individual stocks and stuff, when this happens, a triple top, it fails to continue the rally. So it's over with, things break down from there. But because of all the other fundamentals, since this peak back here, the currency, the national debt has expanded 2.7 times. The M2 currency supply is up 2.2 times. And there is, I was going to start this video with, like you do, a number at the magic number or whatever at the beginning of some videos. I was going to use 2.2 and 2.7. And so we'll get to those. But the currency supplies, the national debt is up 2.7 times. And then we had this inverse head and shoulders forming. And what happens when it breaks that resistance is usually something that resembles a slingshot move. Where can we find an example of that? Look at this, an inverse head and shoulders, and then a slingshot move out of it. Let's move on to the next and investigate this slingshot move a little bit more. This is the inverse head and shoulders, and the bottom, as you can see, came down. It came out down to right about 700, and then there was a neckline, but this was not a triple top that it then violated to the upside, which this is a regular inverse head and shoulders. And then it violated that neckline, and bam, we have 1900, 2.7 times gains. Now, since this 1900, that's where the currencies, I believe it's the M2 currency supply that's either up 2.2 or 2.7 times since then, and the national debt is up. The currency supply is up 2.2. The national debt, I believe, is up 2.7 since this, and this is also 2.7 times. So just for fun, let's take this same chart and let's overlay today's head and shoulders. Just for fun, I just shrunk down this chart, but it overlays very, very well. It's a very, very close match. I don't know what the correlation would be if you ran the numbers on this, but it would be very, very high. And again, we have a triple top here that was then violated to the upside. And, it's come back down below that, up above it. But if we take that same 2.7 times gains, where would we be today? We'd be at $4,300. And so, you did a video very recently on targets for the gold price. And so this is one that is just saying, well, if the history of the global financial crisis of 2008, now I am expecting another global financial crisis. That is what I think lies in our future in 2024. And if not 2024, it's going to be 2025. You cannot perpetuate bubbles of the scale that the Federal Reserve has created and the rest of the world's central banks have created and have them last forever. The free market, sometime or another, will overwhelm it. Got any comments on all of this?
Yeah, I mean, it feels like we're in one ongoing crisis, and it's just the symptoms that vary. I mean, the underlying problem is still there. It's not like we solved it and we're like waiting for a new problem to arise. It's like, it's one ongoing crisis, and it's only a matter of time until something big happens. I do think it's coming soon. Obviously, 2024 is an election year. Things seem to happen in election years.
Yeah, we've done videos on this before, that the Federal Reserve is the emergency, the crisis did not end in 2008. That's just where it sort of began, really. Ben Bernanke papered over cracks, and then papered over, there was QE, but then there was QE2 and QE3, and then Powell did QE4. And the crisis has never ended. We are still in the global financial crisis of 2008, and it's going to get worse. And the bust that is coming, I have been calling for years the Bernanke bust, because it will be his fault, because he introduced Bernankenomics, which is a different type of, what the Federal Reserve and the world's central banks are trying to do is steer economies. So they're trying to steer economics. They're not letting the free market balance things. They're trying to prevent equilibriums from happening. And the free market will always seek these equilibriums. And and eventually it will overwhelm the manipulation and the warping that the Federal Reserve and the world's central banks cause. And the result is that something that they can't manipulate, like the price of gold, suddenly makes up for it. So that's basically the end of this presentation. Any more comments on where you think this is going and the scale of what is about to happen? Because I think that 2008 was just the speed bump on the way to the main event. I've said that 100 times. Actually, Dan was the first one that said it. But the main event still lies out in front of us, and it's going to be worse than 2008. What do you think?
Yeah, I do think there's something coming that'll be worse than 2008, possibly even worse than the Great Depression. Not that I'm rooting for that, but it's definitely possible. And yeah, in terms of the price of gold, it's a ratio, right? It's a ratio essentially of the number of dollars that exist to the number of ounces of gold, approximately. Yes, and so if dollars keep getting created like crazy, eventually the price of gold will account for the imbalance. It's just a question of when. So if people can be patient, eventually it'll get there.
My first book dedicated quite a few pages to this accounting that gold does periodically throughout history. And it does. It's like an automatic thing. It's caused by the free market and the will of the public and the public's mood. Are they scared or not? But it always ends up covering this. And one of the things that people and a whole lot of commentators and newsletter writers and stuff don't realize, and we are going to be doing a video on this someday in the future, and we'll present all of the data for everybody. But the US dollar is backed by gold. It's only the paper dollars, the Federal Reserve notes, all of the gold that was held by the Treasury and all of the gold that was nationalized in 1934, all of that gold was loaned to the Federal Reserve in exchange for $100,000 gold notes by the Treasury. The Treasury holds the notes, the Federal Reserve holds the gold. If you look on the Federal Reserve's balance sheet, you'll see that it is one of the things that backs the Federal Reserve notes in currency in circulation. And they're at the current value that they place on gold, the number of ounces that they have at $42.2222 backs 0.4% of the dollar. It's 0.4 of a penny of gold at that price backing the US dollar. Now, if something goes wrong and there's an emergency, they can revalue gold. And at somewhere in the 9,000s, I think it's like $9,200, $9,300 an ounce right now. The US paper dollar is fully convertible into gold. There's enough ounces at the Federal Reserve to cover every paper dollar printed since they nationalized gold in 1934. Any more comments?
Yeah, there's always enough ounces. It's just it would be a higher price, a higher ratio.
Yeah. Okay, I want to thank everybody for watching. I want to thank you, Alan, for doing this. Please like, subscribe, and smash that notification bell. Thanks, Alan.
Thanks, Mike.